Hello and welcome to the Index Investor. Today we're talking about one of the biggest questions that every investor faces. How do you build a truly diversified portfolio? With index funds now available across equity, debt, and international markets, the choices can really be overwhelming. So, to simplify this, I'm joined by Amitabh Verma. He's director at Fission Wealth, and my colleague Ameya Satyawadi. He's a mutual fund analyst at Value Research. Today, we'll explore what diversification really means, how to get it right, and what are the mistakes that one can avoid. So, welcome, gentlemen.
Thanks a lot. Thanks for having me on the show.
Great to have you here. Let's begin with the big picture. When we say diversification, what exactly are we talking about, and why is it such a non-negotiable for long-term investors?
We are talking of diversification as a very important piece in investing, because today what happens is that if you like something, you invest. If that is an approach, over a period of time, you could have several things which you like, similar things. When you look at diversification, you are looking at different items which are uncorrelated to the widest extent possible, things which fit in with your goals. The market, different asset classes are all cyclical. And therefore, having a basket of investments which are uncorrelated helps you tide through various phases of the market in a relatively smoother form. Mm-hmm. If you look at it a little bit more philosophically, from a behavioral perspective, if there are sharp movements, you tend to stop your investing at some point of time, or you tend to get a little worried. The fact is that you make maximum amount of money if you allow your wealth to compound. Diversification or uncorrelated investing helps you have a smoother experience, which allows you to tide over for longer periods of time. So our experience has been that when you diversify, the portfolio is stronger. In addition, the customer behavior is far more aligned to hold for the longer term, which eventually has an indirect benefit of better returns or better outcomes. The caveat, of course, is that anything which you invest has to be aligned to the investor goals, time horizon. So assuming this is a longer term investor.
And closely linked to diversification is asset allocation. So a lot of investors hear the term, but they don't quite grasp it. So could you explain why asset allocation is often called the foundation of a diversified portfolio?
Yes. See, asset allocation is in terms of trying to quantify what diversification we just talked about. So there are different assets. They could be equity, they could be debt, they could be hybrid, they could be gold, they could be, and so on and so forth. The asset classes are simply continuing to increase. Without trying to complicate it too much, within this, one has to understand what is the risk profile of an investor. Once one understands the risk profile of an investor, then you try and look at what is an adequate diversification. Let me try and explain this with an example. Suppose somebody is a 35-year-old, and I'm just generalizing for the sake of this discussion, who has a long income cycle ahead of himself or herself, and they're looking at adding or investing money today, then possibly the risk profile could be a higher risk taker. In which case, from an asset allocation, you could have a higher mix of equity. And within equity, also, you could say, I have a higher mix of mid cap or small cap, which are a higher risk return asset. While somebody else who is closer to retirement may not want a mix which is skewed towards equity. So asset allocation allows you to diversify your investments aligned to your risk profile and trying to get at a baseline. This is again very important, and I'm sure we'll touch on it as we go further in the discussion, that asset allocation doesn't remain static. Market movements makes the asset allocation move all the time. So when you talk of rebalancing, how do you align where you are, etc., having a base asset allocation is very, very important and foundational in terms of a good starting point when you look at wealth management.
Now let's zoom into equities first. With index funds available across large, mid, and small cap segments, how should an investor think about mixing these buckets? Is it about risk appetite, time horizon, or there's more to it?
See, when you look at index funds and within equity, it is about, of course, it is about horizon. It is about the kind of opportunities which are available. Uh, if you broadly look at, there are three classes: large cap, mid cap, and small cap. You could have various, what should I say, mixed as well, and that's where a flexi cap and or a large and mid cap and various categories are available. But if you look at it, these are three large categories which are there. So based on investment horizon, typically, while you typically say equity has a 3-year plus investment horizon, within that, a mid cap or small cap, the cycles can often be slightly longer if you have drawdown early in your investment journey. Drawdowns can happen, and it is impossible for anybody to predict in advance when a drawdown will happen, because not every variable is in your control. So therefore, from a horizon perspective, within the various sub-asset classes within equity, you could have slightly different horizons. And data has shown that if you are sticking to those horizons, 95 or 98 or whatever the percent or odds are there, that you get an outcome which is aligned to long-term investment records. Obviously, future is never a reflection of the past, but they rhyme in some form or manner. So therefore, horizon is very important. Secondly, in terms of your risk appetite, again becomes relevant in terms of what allocation you're doing. For example, somebody may choose a micro cap index fund. No, there aren't too many in the market, but there are a one-off. Now, micro cap, a single stock picking, etc., becomes very difficult. Even there aren't enough research teams available to do that. So somebody may look at it and say that, okay, large cap I understand, and therefore I don't need to do, and I'll figure out. But this, where do I get the depth of research? And therefore an index is a better way. Somebody else may say that large cap, there's enough data which is available, but there's not so much of alpha creation possible in active management. Therefore, I will try and chase alpha in a mid cap or small cap and therefore be more active there. So there are various ways people look at it. But there is a case for index in each classes, and which is a fairly robust reason why somebody should look at index in each one of them. And again, investor requirements, risk appetite, how they look at it, keeping that in mind.
So that was about equity. Now, a portfolio can't just be equities. What role do debt index funds play in balancing risk and providing stability? And how should investors go about adding to them sensibly?
Yes, you're absolutely right. If you talk of diversification and asset allocation, you can't only have equity. So when you look at debt, and typically if you say 60, 65, 70% is equity, if somebody is a fairly moderately aggressive portfolio, you still have to look at 30, 35% into asset classes other than equity. So debt comes in fairly useful as a debt index funds, wherein you look at, say, government bonds or corporate bonds and various other, within the debt sub-market, to look at what you could look at. In debt, there are 2 or 3 places which is where the market is also fairly active. One is the government bonds or SDLs or and the likes, where you have different maturity index funds. So you could have a shorter term maturity index fund or longer term index maturity fund, depending on what your outlook on interest rates are, but more likely on when do you need the funds. If you're, for example, saving money for the education of a child who's smaller, you could choose a longer horizon because you know that at that point of time when you need funds. So again, like equity, the horizon for investments and your outlook for the debt market helps you in choosing what is the right horizon for investing. And there are certain corporate bond index funds as well. There are certain NBFC index funds which are also there. Again, not a very deep market from a mutual fund index perspective at this point of time. But if somebody is genuinely looking at diversifying, looking at gilt plus SDL, PSU bonds, some nifty bonds index funds, you would get a different asset classes and hopefully some basis points higher yield as a result of different asset classes or sub asset classes within that.
Right, but what happens is many investors see debt as boring or complicated at times. So, can you explain in simple terms how it actually saves a portfolio during tough times?
Yeah, it's definitely not boring. And on a lighter note, given what is happening in the global market, debt is fairly exciting and challenging. But it's a very important piece, because when you look at debt, let me try and look at it slightly in a different way. How do you make money? That's a very important question which you are trying to address. When you try to make money, how you manage drawdowns is equally important in how you manage returns.
Yeah.
If I put it mathematically, if there's a 20% drawdown, and then to go back to the same level, you need a 25% return. It's not 20% will not take you back there. So if you are able in drawdowns to be able to manage that little better, then what you will realize that on the upside, you will have a significant advantage as the markets rebound back. Markets have a cyclicality. Secondly, when you have debt, it is not very easy always to pull out liquidity from somewhere. When the valuations goes down, then at that point of time, you could look at allocating money away tactically, not your core portfolio, but a satellite portfolio, tactically moving a little away from debt to equity. If that happens, then your upsides are also better managed. Otherwise, what would happen? If you have everything in equity and you have a longer term horizon, and assuming it's just market, there's no fundamental reasons to change. When the market goes down, there's only one thing you can do: wait for it to come back, because you're all invested. But if you're not 100% and you have had a proper asset allocation, you have one more tool in your arsenal to be able to use that to give a boost to your portfolio returns. So in fact, in my experience, if you're managing the downsides better, you end up getting your upsides even better. The risk adjusted return is important, and therefore I don't look at debt as a boring part of it. I look at debt as tactically a very important part of the portfolio.
Fair enough. Now, Amay, I'd like to bring you in at this point of time. Beyond Indian equities and bonds, what about international index funds? Do Indian investors really need this global exposure, or is diversification within India itself is enough?
Yes, indeed. International funds deserve a place in an investor's portfolio, but in measured proportion, ideally 10 to 30%, so that it has meaningful contribution to one's portfolio. They allow access to companies and sectors not available in India, such as Alphabet, Meta, or Apple, which operate globally and dominate industries like technology. By choosing an index such as S&P 500 or Nasdaq 100, investors participate in businesses that are adaptive, resilient, and central to global growth. There's also the currency advantage. When the dollar appreciates against the rupee, returns are further enhanced. For instance, an investment in US index since 2020 would have nearly generated 4% annually from currency gains alone. The most valuable aspect, however, is true global diversification.
Amitabh, but the job isn't really over once the portfolio is built. So, how important is rebalancing there? And in practical terms, how often should an investor actually do that rebalance?
You're absolutely right. Building a portfolio is just less than half of the task, because during the lifetime of a journey or life cycle of an investment, the monitoring part of it is in my opinion more important than just the initial build up which happens. One point which I missed out when we talked about initial diversification, and maybe I'll just add very briefly before I come back to this answer. Again, when you look at diversification does not mean taking everything into it, because it has to be a meaningful, and it should not be just for the sake of diversification. Once you have done that with a limited set of what requirements which you have, inevitably the market movements would mean that your portfolio will keep changing, or the asset mix is going to change. If you start looking at trying to rebalance it every day, you are going to only pay the government, one. And secondly, you are going to have the whole purpose of having a good sleep at night is lost.
Yeah.
Why are you doing asset allocation? Why are you doing? Because you want to do what is your core activity, core thing better. And therefore, this is kind of balancing and not having so much of volatility. So you can't do it too often. For different people, it may differ. It could be 3 months, it could be 6 months. Some asset classes could be annual. But it really doing less than 3 months would be just too often from a rebalancing perspective. Secondly, also, if the differential is only a small mix, let me try and explain that. Suppose we had 60% equity and 40% debt. I'm just using it, and it moves to 63% and 37%. Is there a merit in rebalancing it to 60 and 40? Not necessarily, because it hasn't really materially moved from its original. So you could have thresholds above which. So if 60 and 40 moves to 70 and 30, then you would rebalance, or 60 would be 65, 35. Different clients or different people would have different thresholds. But it cannot be just a slight movement, meaning you would look at it. Even if so, you would look at it from a time horizon. You would look at it from a materiality of the deviation, and you would look at sometimes an asset allocation would also change because of opportunistic reasons. But then you are very careful when you're constructing that what is my core and what is my satellite. So in a satellite portfolio, you may change it from an opportunistic perspective as well and change the mix, because you would say so this portion was for this reason. Now there is an opportunity here. So maybe I will make a change. So your asset allocation is changing because of that, but it's more opportunistic. So yes, you should make it very often. You should monitor it closely. You should look at materiality and have a prudent thought in advance rather than reacting at that point of time. Should I make a change? Should I not make a change? Unless there is very, very reason for doing that. Otherwise, just do it as a discipline, I think would have far better outcomes and results than trying to do it ad hoc or trying to do it even too often.
Right. Ameya, from your research, what are some of the common mistakes that people make while trying to diversify?
There are 3 frequent errors that an investor usually does. The first is fund overlap, owning multiple funds that largely invest in same set of companies. For instance, Nifty 100 and Nifty 500 index funds appear different with different investment universe, but share nearly 70% of the holdings, which adds little value proposition to an investor. The second is over diversification. Spreading money across too many funds dilutes the impact of strong performers and weakens wealth creation. The third is diversifying without aligning to goals, which is most crucial indeed. Diversification is meaningful only when it manages volatility while serving short-term, medium-term, and long-term needs of an investor. Without that alignment, it becomes clutter rather than a strategy.
Ameya just mentioned spreading across too many funds. So how many funds are too many in your view?
Difficult question. See, normally 7 to 8 funds are enough for a small size portfolio. As you build out and you start building international diversification, as you look at, I have seen portfolios reach up to 10, 12 funds as well. So it's not that the number of funds is the only criteria which is there, especially when you're looking at index funds. Having too many funds actually just complicates monitoring, just complicates your ability to rebalance as well. So if you look at equity, a few categories are there. You look at gold, silver, you look at debt, different horizons, international. So you're talking of 7, 8 categories which are there by and large. If the amounts are large, then you may say that, okay, in an active fund, you would still say that, okay, this is style is different, this is style different. But in an index fund, trying to do 2 different AMCs doesn't really add any incremental value. He talked about Nifty 500 and Nifty 50 or Nifty 100, there's 70% being a correlation within the same. So therefore, I would think that those numbers would be adequate in 90-95% of the cases.
Now, finally, let's make it actionable for investors. Amitabh, if you had to design 3 simple starting portfolios using only index funds, one conservative, a balanced one, and then an aggressive one, what might those look like?
A conservative, of course, has lower levels of equity and higher levels of, when I say alternates connotes a different sense, so higher levels of non-equity. Let me put it in that way. So equity could be possibly 20 to 40%. The clients who may want 0% as well, but 20 to 40% so that you beat inflation. And within that, you can have a mix of predominantly large cap, because they don't, the volatility is slightly lower. Recent times, though, it's not exactly been that case, but you can't base it on recent times. You look at longer term horizons which are there, and then you have some mix into mid cap and small cap. Then you would look at debt, having possibly an equivalent portion into that, or slightly higher, which would be on the basis of largely government bonds and SDLs, and we talked about the set of products, and you could do that. Sometimes the way I look at it, I look at it in terms of how much do you need for emergency, and have it in really short-term instruments. You could have some things which are longer term, which you don't need, and something for slightly higher yield, and you could have a third, or whatever could be a mix within that, in order to try and look at and higher yield. For example, in this could be a NBFC or something else underlying, which is trying to give you a slightly higher return. And then you would look at commodities, because they have also play a very important role. They are more passives than pure indexes, if I may use the term. They're not exactly indexes, but from a fully diversified portfolio, you could have a gold or a silver, and you would build into that, because that also gives a very different flavor than what is there. You could have I'm not sure in a conservative fund how much of an international diversification one would be looking at. So unless there is a need, or the client has kids overseas, or there's a reason why you're looking at from dollar denominated, very low, or you could leave it at 4. When you look at going from a more moderate portfolio, you start changing the mix a bit. The equity moves up to 40 to 60% instead of 20 to 40%, and commodities remain where they are. You would have debt coming down a little bit, especially given the new taxation. It sometimes becomes more difficult to convince customers to add a lot of debt and just government bonds into that. But we discussed why it's very, very important. So you would have that, and you could possibly start and have a little bit of international divestment as well. And as Ameya rightly pointed out, that there are several businesses which you cannot get in India, whatever you do. And therefore, those businesses, if you want to have, and today we consume a lot of things, and which are growing, but the underlying company is not in India. So you start getting some of those into those portfolios. When you look at an aggressive portfolio, you start moving 60 to 80% into equity. An aggressive portfolio does not mean 100% equity, in my mind. So 60 to 80% equity. You have a little bit of debt, both from the reasons we talked about balancing, about having the arsenal, as well as for managing opportunistic cases. The international becomes definitely a very important part. And Ameya talked of 10 to 20%. I would think that that's definitely should be a part of an aggressive investment portfolio. And you would have commodities, which is a balance. So for different customers, there would be slight tweaking based on the goals, because an asset allocation without goals, and as you said, the third mistake, I don't want to commit the third mistake of talking of asset allocation without understanding a customer's goals or needs. So that will be an overlay onto that. But I would think that these, if you look at it in this manner, probably you would be able to align a representative customer's needs in a lot better.
Right. So I think the message is quite simple there. Diversification isn't about owning dozens of funds. It's about the right asset mix, sensible allocation, and the discipline to rebalance. And index funds make it easier than ever, whether you're building a conservative, balanced, or an aggressive portfolio. Thank you, gentlemen, for breaking it down so clearly.
Thanks a lot, Ruchira, for keep having me on the show.